Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis. A warm welcome to Money Talk for Monday the 15th of April. In just a moment, I'll have some headlines for you to kick off the new business week. In today's business and finance headlines, Iran launched dozens of drones and missiles at Israel in a retaliatory attack on Sunday. It's the first ever Iranian attack on Israel from Iranian soil. Oil prices continued their rise Friday on the reports that Israel was preparing for the attack by Iran over the weekend. China's exports fell far short of expectations in March, recording a 7.5% fall year-on-year, highlighting an uneven recovery in the country and dashing hopes that global demand would continue to help drive growth in the world's second largest economy. Singapore's economy grew 2.7% year-on-year in the first quarter, missing forecasts despite a surge in tourism. This was faster than the 2.2% uptick in the October to December quarter, and the strongest rise since Q3 of 2022. But growth in the manufacturing sector slowed to 0.8% year-on-year, down from 1.4% in the previous quarter.
Peter Lewis's Money Talk.
I'm joined now by Shanghai-based independent economist Andy Xie. Good morning to you, Andy.
Good morning, Peter.
Let me kick off by asking you about the trade data that came out on Friday. Exports fell quite a way short of expectations. They fell 7.5% year on year. What does this mean for China's economy? And also the fact that it's really wants to try and boost its economy by relying more on exports.
Yeah, I think that a little bit weaker than expected, but mostly due to the high base effect. Last year, in March, export rose by nearly 15%, but the whole year was flat. So it's not as bad as it appears. You look at the first quarter. In March, PMI actually rose at over 50, and iron ore imports in the first quarter were quite strong, up 5%. So the industrial picture looks okay, and also auto sales rose by nearly 10%. So I think that the picture is okay. I think that for the whole year, exports could have rose close to 10% because of the low base last year, and the inventory has been digested.
Do you think that can continue, particularly with the geopolitical situation where China's coming under pressure from the US, from Janet Yellen last week to try and rely less on exports, which she says the world economy just can't cope with, and boost its domestic demand? And we have the German Chancellor in Beijing this week, presumably delivering the same message.
Yeah, I think that the U.S. is trying to spin this is that it's overcapacity, subsidy dumping. These are new catchwords to describe China. I think that the issue is that there's a buyer, there's a seller. If you don't want to buy, you don't buy. Okay, so on the domestic demand stimulus side, I've been arguing that China needs to boost household disposable income for many years, but right now the household the balance sheet is very good because they are not buying properties like before, and the cash actually is piling up in the banks, so there's no purchasing power problem. So I'm not sure that the tax cuts are really urgent right now in terms of boosting demand. The second point is that when you really want to boost demand, you're really talking about a property, and that is a bad thing because China did that many times before, and it's just making the bubble bigger. So that's what the U.S. wants: is make push China to revive the bubble and make it bigger and prop up the global economy. Then it pops and it takes down China, right? So I think that property sales are weak. People are rational, and this is a bubble. It needs to be cleaned out. So I think that so far demand side story, demand stimulus is not strong.
So if it can't rely on the property sector, what China's trying to do, obviously, is put more and more resources into other high-tech sectors, new technologies, electric vehicles, and so on. Is the West right when they say that this is unfair because of all the subsidies, or is China right when it says it's not because of the subsidies, it's because our product is better, and it's cheaper, and therefore the US ought to focus on making its own industries more competitive? Who's right here?
Someone just came up with this number that BYD got like over $3 billion in subsidy. It's became a global headline. That is actually a small number. You look at what the U.S. did for the auto companies in 2008. Over $10 billion. Then you look at what the Europeans do when they try to attract an auto company to invest. And you look at the U.S. Inflation Reduction Act, how much subsidies involved for the new technology companies, and the amount of purchase subsidies involved is much bigger than China's. China has no purchase subsidies anymore. So this is it's really it's a perception game. And the U.S.'s main strategy towards China is basically has two planks. One is cutting off the access to technology. The other is basically propaganda warfare to demonize China. So I think that's what's going on. But in terms of you look at the reality, EV battery is the key to EV, and the battery price in China fell by over by 50% in the last year and a half, and it's expected to fall another 50% this year. When you have a price decline like that, it cannot be due to subsidy. No amount of subsidy can make that happen. This is due to innovation and scale, and also the second generation LFP BYD blade battery, and the density is up from 140 to 190 kilowatt per kilogram. So we're seeing tremendous progress on the EV side in terms of productivity, and that is repeating the story we saw in the solar side. And the solar price since came to China down by 95%, and no amount of subsidy can make that happen. It is due to innovation.
So when Janet Yellen holds these talks with her counterparts in China about sort of the over-competitiveness as it's described, and sort of trying to reduce that, where are these talks going to get to? Are they going to have any impact at all?
No, not at all. I don't think so. But what surprises me is that the U.S. is not talking about an exchange rate. That's what the U.S. did in 1985 through the Plaza Accord. They got Japan and Germany to double the value of their currencies. And in 1971, the U.S. abandoned the Bretton Woods system, basically depegged the dollar from gold, and at $36 per ounce. So it's been the U.S. dollar devalued sharply. So this is if you think that the Chinese price is too low, then maybe there's an exchange rate issue, which I believe there is an issue. Chinese currency is undervalued. But the U.S. is not focusing on that, because the U.S. is
Because presumably they're not focusing on it because it's happening slowly, isn't it? There is a devaluation of the yuan.
No.
Going on.
I think there's geopolitical situation. First, everybody emphasizes China's economy is the second largest economy in the world. But in fact, at a price parity, Chinese economy is far bigger than the U.S. My calculation is that it's twice as big. Okay, so and if Chinese currency doubles in value, obviously Chinese economy is much bigger than the U.S. It's got geopolitical implications that the U.S. is unwilling to face up to, because it makes China obviously Chinese import market will become much bigger, and right now twice as many countries have China as the largest trading partner as the U.S. So if the currency doubles, obviously it will move this number much higher. So the U.S. will become less relevant in the global economy. That's something that the U.S. is not willing to face up to. The other is inflation impact. After 1985 or after 1971, you got inflation, and the interest rate at 5.5% is considered low. Which is where it is now. So interest rate is like to rise. Now, the difference between now and 85 is that the U.S. debt level is much higher. It's 130% of GDP. And when interest rises, it could trigger a debt crisis. Okay, so the U.S. is in a bind. It cannot use the normal economics to address its issues now. So it's trying to pressure China to do something for the U.S. to work with the U.S. macro. Okay, so maybe China should raise its own price, may raise its own cost, reduce its production. So that's one point, right? The other is that it's much more financial strategy. The U.S. the economy depends on government borrowing money to spend. So it's trying to make China appear untouchable. The point is to get the Chinese money to flow out through Singapore or other offshore money centers. The money ultimately will go to the U.S. Okay, so that's how you sustain the U.S.'s current economic model. You need to have money coming in, and China has $1 trillion in trade surplus. The U.S. has $1 trillion in trade deficit. One way or another, the money has to flow from China to the U.S. to make it whole. Okay, so it doesn't matter how it appears on surface. That ultimately, that's what has to happen. Okay, so the U.S. is that's why U.S. propaganda strategy makes a lot of sense from its perspective. Yeah, the key is to undermine the confidence in Chinese economy among Chinese, especially rich Chinese, so they take their money to Singapore.
So presumably you say there's going to be a debt crisis. I mean, obviously interest rates in the US are at 5.25%, and maybe they may stay there now for the whole year. The worry is that the Fed won't be able to cut interest rates at all. The problem is people have been worried about a debt crisis in the US for years, and so far it hasn't happened. But do you think the economy is getting close to that point now?
The key is that China's currency is pegged to the dollar. So the currency market cannot put a pressure on the U.S. macro policy. It's the only debt market. Okay, and the Federal Reserve has quite a bit of control over the debt market. So it's got a huge balance sheet, and it can move its position from like a short end to long end to manipulate the market. So this is one thing. The other is that the savings are coming from East Asia, like China and Japan. And the U.S. has quite a bit of control over here. The key is that to have low confidence in Chinese economy. Okay, so the money leaves. Okay, so this is where the U.S. strategy is not to solve its own problem. It's waiting for China to collapse. Okay, so it's just like in 1998 when the East Asia collapsed, the money all went to the U.S. and that led to this dot-com bubble. The U.S. invested a lot, and it eventually led to this 2008 bubble and bursting. And the U.S. then got China to inflate like crazy, and it also spent some money, so it got in on the path of another bubble. Okay, that bubble has lasted to where it is today, and it's precarious. It's true, it's precarious, but the U.S. strategy is to crash the confidence in China and make the money inside China to come to prop up the U.S. And eventually, if China crashes, so it becomes self-fulfilling. See, all the money will go to the United States.
So if that is the deliberate policy, as you say, of the US to try and undermine confidence in the Chinese economy, cause the Chinese economy to collapse, which of course the US denies, it says it's not trying to do that, but nevertheless, if that is the underlying strategy, then presumably all these trade tensions, geopolitical tensions are only going to get worse. We're going to see more tariffs, we're going to see more restrictions on Chinese companies, on tech exports and so on. This is going to get a lot worse, isn't it?
Oh yeah, the issue is that the U.S. is importing more from China now. So the U.S. is not wants its economy to weaken. Okay, so in terms of this trade side, it's more a perception game. They trying to make China toxic. So people don't come to China, and other countries don't want to deal with China, and businesses pull out of China. So that's the game plan. In terms of what the U.S. does with the substance is cutting off technology access. So they put more and more Chinese companies on this so-called entity list, and that list will go up and up until every company in China is on the list. Okay, so that's where we're headed, and China is pouring money into technology to develop its own technology and to develop alternatives. So that's what we are seeing. So this is the real game. This is the real game, and obviously. And China is trying to reduce demand reduce purchases of the U.S. technology, and U.S. technology companies like semiconductor companies or like Apple, they make more money in China than in the United States. Obviously, there's a consideration there. Let's see how fast the U.S. goes down that path. Eventually, China and the U.S. will be completely separate. How fast we get there, it really depends on domestic interests in the United States.
Okay. Well, we had a report, didn't we, in the Wall Street Journal on Friday that China's also trying to accelerate the removal of foreign-made chips from some of its critical infrastructure, which hit the share prices of companies like Intel and AMD. So presumably, China is also going to take steps to protect its domestic economy.
Yeah, in long term, obviously, the U.S. government will never use Chinese technology. So China will need to do that down the road. But the key is that to put pressure on the U.S. technology companies, so they understand that the Chinese market is at risk. Are they ready to abandon Chinese market? And are they ready to sacrifice so much profit? So if they're not, they will put pressure on the U.S. government to slow down the pace of decoupling. So this is the technology, the real thing. The technology is the real thing. And China is developing alternative technologies. If China makes it, and it's only a matter of time, then this will become very interesting. I think the U.S. will be in a pretty difficult spot.
Very interesting indeed. Well, I'd love to talk to you more about that. Sadly, we've run out of time, but we will definitely pick up this conversation again more in the future. Thank you very much, Andy. That's Shanghai-based independent economist Andy Xie.
You're listening to Peter Lewis's Money Talk.
Money Talk.